just wondering as to where the US bond yield is heading next, because on a daily basis, not just India, but global markets have been just so sensitive to the movements.
You're right, and that's the magic question. I think that 1.7 is we have our forecast for the end of the year, but I think for the Federal Reserve, 2% is the line in the sand, and the reason is that Janet Yellen gave an interview in the New York Times late last month, and she said you have to look at the cost of debt when you decide whether a country's borrowing too much. And she said currently that's under 2%. And so we can afford to borrow more. And just to me, the very simple inference is that the Fed will let it go up to about 2%. And then I think it might start to address the rising bond yield directly.
Right. Mark, also wondering as to, the other trend which is playing out, and not just for India, but across global markets as well, as to how growth is taking a back seat while growth has been in favor for the last 5 to 7 years. It's value which is now emerging as a winner. Would you say that this style of investing is going to be beneficial for at least the next foreseeable future?
Yes, I think the current has changed. And the tide is going out. And so you can get little ripples that go against the tide, little counter trends. Maybe we're seeing one this morning. But the longer term trend, I think, is an irrefutable shift from growth to value, because the economy is recovering in America and around the world. That should be accompanied by a gradual trend higher in interest rates. And historically, at least, growth stocks don't like higher interest rates. Value stocks do.
Mark, I look at the world and I say, look, when economy is not doing well, central bankers are printing money. When economy is doing well, there is reason to get optimistic that finally after years of slump, things are looking up. Why should markets be concerned? I mean, we all want growth to come back. If growth is coming back, we should be happy rather than crying.
Yes, I guess the thing is that there are two things that move markets: liquidity and fundamentals. The liquidity was very ample last year. And it still is. The liquidity conditions, the monetary conditions are still very loose. And we know there's lots more money that's going to be pushed into the economy with Joe Biden's stimulus plan. However, a rising bond yield will eventually make bonds look attractive at some point. In fact, the 10-year Treasury yield is now higher than the S&P's dividend yield for the first time in over a year. But then the other side of the equation is valuations. And there's no denying for the benchmarks, the S&P 500, the MSCI World Index, where 7 out of the top 10 stocks in both are U.S. technology stocks. These are expensive stocks. So it doesn't mean the entire market is expensive. Value is not expensive. There are lots of other markets that aren't expensive, but the leaders that took the market up and are now kind of rolling over, they are expensive. Sorry, I can't hear you.
Okay. Mark, how closely are you monitoring also the uptick that we've seen in crude? We were just discussing whether or not that would have a worrying impact on some of the major economies, including India's. Is that a factor that you feel that one should start taking into consideration, or are you still optimistic about the pace of the recovery unhindered, by the kind of rise we're seeing on those crude prices?
Well, the first thing I would say is I don't think oil at whatever it is now, $66 a barrel thereabouts, is sustainable. It was our fair value for it is about $55 a barrel. And the reason it got to where it is now is, number one, the cold spell in Texas, which took out a lot of the electricity grid, and that's being resolved now. And number two, the attack on Saudi oil field yesterday. But those, I feel, are transitory. They're the kind of black swans that you can't predict: freak weather, terrorist attacks. They're an unfortunate part of life, but we can't just lock ourselves in a closet and not do anything, because those things happen once in a while. I don't think we're going to have an attack on Saudi oil fields every day. I don't think we're going to have freak weather in the United States every day. And so I would be a seller of oil at this price. But the other thing I want to say is that India is blessed with a temperature that is very favorable, a weather, I should say, for solar power. The monsoon season lasts, 2 or 3 months, and most of the rest of the time it's sunny. So already there's a lot of solar that's been put in place for industry. And in the budget, the government gave a very aggressive target. I don't remember what it was off the top of my head for solar. And I think they can get there. So I feel that oil will eventually be much less of a weight on the Indian economy than it has been historically.
Okay, that's great to hear. And you were talking about the yields and the 2% mark coming in. As the Fed has signaled time and again, is their line in the sand. How close do you really feel they are to crossing that? Because just until a few months ago, it seemed that inflation would just not come back that quickly. In fact, 2% seemed a very far away target. So, so just want to probe into that deeper and get a sense from you on how real these concerns are. Janet Yellen, of course, as you touched upon in your opening answer, completely assuaging the market and talking about it being a far-off event. But it does seem to be a little bit closer than initially thought.
You're absolutely right. This is the central issue, because if we can get this right, we'll get everything right in terms of value versus growth and bonds versus stocks and really big picture stuff. I think an honest question deserves an honest answer. I don't know. Nobody knows, because we're in uncharted territory here. What I mean by that is, ever since Ronald Reagan and Margaret Thatcher, whenever there was a recession, the governments wouldn't intervene, and they would leave it up to central banks to cut interest rates and print a lot of money. This time it's different. The American government in particular is doing fiscal stimulus, the likes of which we haven't seen, I suppose, at least since Lyndon Johnson in the 1960s. And so that fiscal response is creating a tremendous amount of money supply in the general economy, which in quantitative easing, it mostly stayed in the banking system in Wall Street. So it made, stocks and bonds go up, but it didn't really get out into the real economy. This time it's getting out in the real economy, and we're seeing signs in inventory levels, which are very low in small businesses, and the prices of the products that small businesses make, they're rising quite quickly. And they tend to lead the actual core CPI by about 6 months in the United States. So there is inflation coming. We all know it. The million-dollar question, is it transitory? That, I think, we will only know with the passage of time. But what I would say is the fiscal response suggests that the inflation could be bigger this time than in past recoveries.
Mark, they say history may not repeat itself, but it rhymes itself. Which part of the historical correlation this time you think will hold true and will not hold true? What I'm trying to understand from you, Mark, is that weakness in dollar is good news for emerging markets and commodities. Will that correlation once again, hold true?
Also such an important question. So right now the dollar is rising. And interestingly to me, the Asian markets aren't really taking it on the chin the way they usually do with the rising dollar. That correlation inverse correlation, I should say, between the dollar and the emerging markets actually only dates back to 1995, which I suppose is a long time ago. But still, I even can remember that prior to 95, that correlation didn't exist. So correlations don't last forever. It is possible that we could have a gradually increasing dollar and still have a positive performance in Asia. So far, it seems to be that way, actually. So fingers crossed.
Mark, the first port of call in any uncertain market is that you buy gold. In this low yield environment, gold, which historically has given you the best returns and is the best against inflation, has been a massive underperformer. Has the definition of how you invest in gold changed? Are we looking at a new world, whether it is Bitcoin or whether it is the liquidity environment? Gold is no longer the so-called go-to hedge?
Well, it is, but you have to remember it did very well last year because of the coronavirus pandemic. And I can't say whether the coronavirus pandemic is coming to an end or not, but it looks like it is in the large Western economies. And therefore, there is a certain, fear factor that was imbued in the gold price that has come out of it. I think it's a very difficult asset to value. How do you put a price on it? It just sits there, doesn't do anything. But clearly, going back to before even history, we've been in love with gold, human beings. It just has something very particular about it that copper or platinum or silver don't have. So I feel that the gold price should bottom at about 1,600 thereabouts, and it would be fine to start buying some now if you don't have any. Reason being that the central banks of the world are still going to keep policies loose. And governments in the Western world are starting to engage in a lot of fiscal stimulus. And that should mean their currencies devalue versus real assets. Real assets are basically real estate and commodities, and gold is a commodity. So, sorry, long-winded answer to your question, but it's a very difficult thing, gold. It's a mysterious metal. But I think that it's in buy territory now.
Okay. On India, Mark, and you're sounding so bullish on the prospects here. Tell us a little bit more about your latest report, the kind of recovery you're anticipating in the segments of the market as well that you're then focusing on in light of that.
Well, what you're referring to is last week we upgraded India from a market weight to an overweight for our investors globally. And if I was just to run through the key points, the first is there appears to be some herd immunity in certain parts of the country because the COVID cases are not nearly as bad as they were before. It's not the only one. I think there's probably quite a lot of herd immunity in the United States as well, for example. And then the second thing is the budget was very special, in my opinion, and the finance minister had promised, the biggest in 100 years. I really think she delivered. The bad bank being set up is a great thing. The divestment plan of PSUs and the IPO for Life Corporation of India later this year, Life Insurance Corporation, and then getting India's sovereigns included in global bond indices and opening up the local bond market to retail investors so they can more easily access it. And then on top of that, very strong recovery. So we're forecasting 9% GDP growth for India this year, 7% next year. No other country we cover has that kind of GDP growth. Not even China. And so that will mean, we think, that earnings growth will be in excess of 25% this year and next year. And in a nutshell, that makes us optimistic on India. Sector-wise, I mean, there's a lot of things going on, a lot of good things going on. But having just mentioned the creation of a bad bank, that I think will bring down the non-performing assets of the banks, public sector banks in particular, in conjunction with a strong economic recovery and gradually rising interest rates. I think one port of call could be, therefore, the banks.
Okay, so banks definitely looking exciting there. And I know we touched upon crude, but what about commodities other than that in terms of metals, for example? And that's, again, been a volatile area globally as well. Want to get your thoughts there.
Yes, well, the metals complex is the industrial metals has already done extremely well, as you know, copper and whatnot. I believe the prices will be supported by the global economic recovery and the increased usage of those things in many of our the things that we use in our day-to-day lives. There'll be much more copper used in appliances for the Internet of Things and in electric vehicles. They use 5 times as much as internal combustion engine cars, for example. And I don't know about India, but in many parts of the world, there's kind of a property boom going on. There certainly is in America. There is in Canada, Australia, here in Singapore. There's sort of a very subtle one, and lots of other places. So that is steel, which requires iron ore. So I think there's an economic rationale for these prices remaining strong, and if they do, or at least remaining where they are, then I think the metals producers, the commodity producers, can continue to re-rate because they underperformed the broader market for over 10 years.